Welcome to House Money, the podcast that cuts through the noise for buyers, sellers, and agents along the Wasatch Front and beyond. Together, we dive into unfiltered, no-nonsense insights to help you win in today's market, whether you're buying your first home, selling smart, or stepping up as an agent. No fluff, just real strategies that work. This is House Money. What would it take for the average family in Salt Lake City to afford the median home? And what happens if mortgage rates were to drop significantly? Spoiler alert, it might not be the win that you're hoping for. Welcome to the House Money Podcast. I am Rychen Jones, your host. I'm a realtor and an associate broker here in the Salt Lake City, Utah area. I'm glad you have found us. Here's some updated data for you. As of February 2025, this is data that just came out from UtahRealEstate.com here this week. As of February 2025, the median single-family priced home in Salt Lake County is $552,000. But the median income is only a little above $103,000, and that's a huge gap. If we look at the house price to income ratio, Salt Lake City's ratio right now is about 5.3. That's more than double the recommended 2.6. And that's making home ownership a challenge for many, many people. This is not new. If you're in the housing market, if you're looking to buy your first home, your next home, you know this. You know that prices seem higher, potentially unaffordable for you. So here's the question. What would need to happen for the median home to be able to be affordable for the median income? Let's break this down. We have three scenarios that we can look at. We're going to go through a lot of numbers and data here. I'm going to provide a document in the show notes where I will take you to a PDF where you can see all of the assumptions and all the math that we're going to talk about here. The first scenario, scenario A, is if home prices dropped. In order for home prices to drop to a level where the median income could afford the median home, prices would need to drop by about $154,000. That's a 28% drop to about $397,000. But with Salt Lake City's tight inventory and forecasted growth, it's forecasted to be about 3.2% through 2025. It's unlikely that we're going to see a drop in prices of 28%. Scenario B would be an increase in income, and incomes would need to rise by about $40,000 or almost 39% to a median income of $143,000 to afford the $552,000 median priced home. That's a big jump. And if you look at the income growth in Utah in the last 25 years, it has lagged behind home prices. In fact, there's a Deseret News article from November 2023, so it's a little bit old right now, but from 2000 to when the article was written in November 2023, home prices had increased by 162%, while increase in income was only 78%. So to ask for a 39% increase in median income is a tall task and also probably unlikely. The third scenario we can look at is if interest rates were to drop. Rates would need to drop to 3.7%. That's a 2.8% percentage decrease from 6.5%, which is where we've been the last couple of weeks. That's a significant drop. And while it's not out of the question, it's definitely not probable either. If we get to 3.7% interest rates, we're probably in a recession. There's probably increased unemployment, and there's a lot going on probably that is going to cause a 3.7 interest rate environment. That's not to say that interest rates couldn't drop a little bit more depending on what's happening with economic factors, but to get to a 3.7 interest rate where the median income could then afford the median house is also probably not real likely. Don't worry, I've got some solutions coming up here, but let's just play this out for a minute here. What happens if rates did drop to 3.7%? I said, spoiler alert, it might not be the win you're hoping for in the beginning, because let's think through this. If 3.7 interest rates were a thing again, what would happen to buyer demand? Well, there are many, many buyers that are on the fence, who have been on the fence for a couple of years now since rates started to rise, who would probably try to come back into the market. Lower rates would cut monthly costs. It would help more buyers qualify for that median priced home, and that's going to draw these buyers out from whether they're renting or that it's time for them to sell their house and move to their next home. It's going to bring more competition into the market. And what did we see when there was more competition during the COVID years? We saw multiple offers. And what did multiple offers create? Increasing purchase prices, appreciation. In 2021, when rates were around 3%, 36.2% of Salt Lake homes sold above list price, according to Redfin in April 2023. I think that number actually feels incredibly low, but it's Redfin. We'll just take it for what it is. You can go find the research study if you want. A drop to 3.7% in interest rates would create bidding wars that we have not seen since 2020, 2021, and early first quarter 2022, especially with Utah's deficit in housing right now. Naturally, we would see the result of this in prices skyrocketing. Even a 10% increase in price, in this case, that would put it at $607,000, would raise your monthly payment at 3.7% a little bit more, so that the savings you think you actually might get based upon the day's median sales price isn't going to be that much at all. It's basically going to be paying the same amount, more or less, than you would be paying today at 6.5% if that's the rate you were getting. So, what do you do right now if you're a buyer and you're in this position where we don't expect incomes to go up 40%, we don't expect prices to come down by 28%, and we probably don't expect rates to drop to 3.7%? If you're waiting for rates to drop, let me give you 3 reasons why that's a risky strategy. First, it's unlikely to happen soon. As we talked about, from rates to go to 6.5% to 3.7% would take a pretty drastic economic event, which probably comes with it recession, higher unemployment, things like that. The second thing is that if we do get to 3.7%, or if rates even drop significantly, prices are going to increase, but payments are going to stay similar because we're going to have appreciation. Prices are going to be even more than the median price they are now because more buyers will be coming in the market. There will be higher demand, multiple offers, prices going up and up and up because people are going to want to jump in on their 4%, 3.7% rate, whatever rates happen to be. We know as rates continue to drop, more buyers are going to go into the market and prices are going to rise. That's why it's a very delicate balance that the Fed is doing right now, trying to balance interest rates, which are not mortgage rates, but interest rates with how the economy is running. From a mortgage rate perspective, as interest rates continue to come down, buyers flock to the market, there's more demand and prices go up, right? The third thing we're going to see, if there is increased competition, we're going to see fewer concessions from sellers. In a low rate, high demand market, sellers won't offer concessions like closing costs or repairs. We saw this during the COVID years. We saw this when prices were appreciating, when every house was getting, dozens of offers. Concessions weren't there. Sometimes buyers were having to, or were willing to, I should say, waive due diligence altogether, which, if you've listened to any of these episodes, I think that was realtor malpractice. I don't think it should happen. I always think a buyer should get an inspection and be able to negotiate repairs if necessary. But that's what happens. Buyers are going to lose leverage if interest rates drop significantly because there will be increased competition, fewer concessions, higher prices, similar payments, and we're not likely to see a drastic drop in interest rates anyway. So, what do? Here's your call to action, buyers. Don't wait for rates to drop. Look, I get what I'm about to say is going to sound very salesy coming from a real estate agent. But if you're able to right now, you should be looking to buy while inventory is up slightly, competition is manageable, we're still getting concessions from sellers to where you can buy down your rate or cover your closing costs. Lock in that rate now, even if it's at 6.5%, or you buy it down to 6 or whatever it is may be. And then if rates do drop, you can refinance it. Now, I am not a marry the house, date the rate person. Again, if you've listened to any of these episodes, you know that how I feel about that phrase, marry the house, date the rate. That is also realtor malpractice, and lenders, that is lender malpractice as well. But you at least lock yourself into a home at a rate that you can pay right now, a payment you can pay right now. And if you get the opportunity to refinance later on, you'll be in an even better spot. You won't be competing with multiple buyers and multiple offers and overpaying and having your payment be essentially what it would be right now anyway. In the meantime, you get all the benefits of homeownership. It's a forced savings account if you like to think of it that way. You get appreciation year to year to year if you like to think of it that way. You have the pride of homeownership. You can paint the wall green if you want to paint the wall green, but you're never going to get there if you're continually waiting for rates to drop. There's always going to be something you're waiting for. Rates to drop, prices to drop, incomes to go up, more homes to be available. You're always going to be waiting for something. In the meantime, you're spending what, $2,500 a month, $30,000 a year on rent for what? Because I can tell you exactly what you get out of that. You get zero out of that. My best advice to you as a home buyer right now, or a potential home buyer right now, is to get with a good agent who knows the market, who can walk you through these things. Get with a great lender who can explain the different options and different products available. Not all lenders are created equally. Lenders are very different in the products they offer, in their expertise, in their crafting of that loan, and how it can be best for you and your situation, how they can explain the market to you and what their projections are, what can happen if rates were to drop. Are you going to be able to refi? What programs are available there? They can help you build your credit, but you need to put good people around you to guide you through this. Hoping and waiting is not a strategy, folks. I'm sorry I have to be the one to tell you that, but it's just not. We're not soft and fluffy here on House Money. We tell it like it is, and that's how it is. Rates are not likely to drop significantly. Home prices are not likely to drop significantly, and incomes are not likely to increase significantly. So, what do? We figure out a way to make it work right now, if possible. And if not possible right now, that's okay too. Let's make a plan to where it can be possible. Maybe that's 6 months, maybe that's 12 months, maybe 18 months. Whatever it is, let's make a plan to get you moving in the right direction so that you're not waiting and waiting and waiting for external forces to change that you have no control over. Let's put you in control. Let's figure out what you can do. Let's put you in the best position possible so you can enjoy homeownership and homeownership success. That's what I got for you today on House Money. I am Rychen Jones, and we will talk to you next time.